Well, the Asian markets, they're trading higher despite a weak handover that we saw from Wall Street on Friday. The Japanese index is up close to around 150 points odd. So keep an eye out on that one. You have the dollar yen as well that's holding at around 112 odd mark. But it's not just a developed market like the Japanese market that's moving higher. There's green on the screen. Pull up the Kospi, pull up the Straits as well as the Taiwanese index. We have all those indices that have opened up, and they've opened up with gains of around 0.3% to close to around 1% as well. So quite a good start, for today's trading session. And the SGX Nifty, that's reflecting that, at least for the time being. So a positive start is what we could have. Remember, we pulled back a tad bit from the lows that we saw in Friday's trading session. But after a 70-point bump up, it'll be interesting to see whether or not there's more buying that comes out there if we get that. Maybe it could be a 50-point bump up or so. Or maybe, in fact, the bears come in there and they look at selling into this market. But good to see positive cues coming in from the Asian markets.
Okay, so positive cues coming in from the Asian markets, but that was not the case in the US markets at all. In fact, it was a volatile session on Friday with stocks ending with deep cuts. Now, the Dow dropped nearly 300 points. The Nasdaq Composite dropped over 2% in trade, while the S&P 500 also saw a gash of around 1.7%. Briefly entering into the correction territory. Now, while the economic data was better than expectation with the Q3 GDP coming in at a number of 3.5%, it was weak top line from the likes of Amazon and Alphabet that really disappointed the investors. In fact, CNBC's Leslie Picker gets us a wrap of all the action on Wall Street that happened on Friday.
U.S. stocks seeing red following another late-day sell-off. The Dow off 296 points, the S&P lower by 46, and the Nasdaq down 151. Despite the sell-off, the U.S. economy seems to be humming along. GDP came in at 3.5% in the third quarter, according to the Commerce Department. That was slightly better than expected and came thanks to a strong showing from consumer spending in the quarter. Amazon shares, meanwhile, sinking after the e-commerce giant reported disappointing revenue and weaker than expected guidance. Amazon did, however, report strong growth in the company's cloud computing and advertising businesses. The stock down about 8%, dragging down the Nasdaq to its worst month since the 2008 financial crisis. And the FBI is reportedly reviewing Tesla's Model 3 production numbers as part of an ongoing criminal probe into whether the company misled investors. That, according to a Wall Street Journal report. According to the Journal, federal agents are reviewing Tesla's stated Model 3 numbers dating back to 2017. Tesla's struggle to ramp up production for the Model 3 has been a pressure point for investors. That's the action from the U.S. market. Back to you in Mumbai.
Well, on that note, let's hear out some important views coming in from experts on the road ahead for the U.S. markets as well as the U.S. economy.
Investors have come to realize financial repression is over. The era of zero interest rates to first keep us out of a depression a decade ago and then get the economy going, no longer here. With the aid of fiscal policy, the economy is doing pretty well. And so rates all across the curve are moving up, which means PEs are moving down. Investors are worried that double-digit earnings growth isn't going to last forever. I mean, we all knew that, but they're just waking up to that, and so that's a concern for E. So we have a PE concern and an E concern, and so there's a little air pocket.
Earnings disappointed a little bit. You talked about rates, and some people worried about rates slowing growth. We've had trade concerns. To me, it all rolls up to the question of, where are we on the cycle, and is growth slowing? Investors need to see comfort that this is not the end of the cycle. We want to see some policy. So I think China is probably the key lever there because they're the only country that really has significant policy tools. They've announced some measures last week. We probably need to see more. We also need to see the actual impact of that, like seeing stabilization in China, acceleration. Because to me, ultimately, this kind of rolls up into kind of a growth scare, even though it sort of doesn't, the U.S. economy is going strong, but that's effectively what it is. And so we need to kind of get past that stage.
Powell certainly gave the impression that they thought the economy is gangbusters and that they can afford to keep raising rates, at kind of this accelerated rate. I still think that feels true to me. I agree with you. It feels true to me
that's what you think the Fed
that
Powell,
I think overall the Fed is thinking that, and that Powell maybe himself is thinking it. It's not appropriate, in my view, what the president has been saying about the Fed. that he shouldn't be publicly saying that. But on some of his content, I don't disagree with what the president said, that if the Fed raises too fast, that has been one of the major causes of recession in the United States.
Okay, on that note, let's get in some more important opinion coming in from Robert Schiller of Yale University, who says that U.S. economy is still doing well and that the Federal Reserve is actually being proactive with its policy. Take a look.
You know, ultimately, when we say strong economy, I like to use instead the term exuberant economy. This boom has been going on for a long time, and people are getting antsy and starting to pull back. Whether it's a real correction or a bear market, I don't know. Fed policy, I think, is needed. We have the lowest unemployment rate since 1969. And you know what happened after that in 1969? We had runaway inflation. It got out of control. It was considered the worst problem facing the country. So there's also an argument for what Powell is doing, which is being proactive and preventing inflationary expectations from even getting started. Even though at the moment it doesn't look that way.
Well, turning our attention to the European markets, they closed lower on Friday's trading session, tracking the declines that we saw in U.S. stocks. The FTSE, in fact, ended with a cut of around 1.4%, or the CAC as well was lower, and the German DAX as well lost close to around more than 1.5% in Friday's trading session. Now, shifting focus to the Brazilian index, well, Bolsonaro's election win seems to have boosted that market out there. The Tokyo-listed Brazilian stock exchange traded funds, that's up close to around 14% approximately. For the month of October itself, we have been talking about the Dow seeing a cut of around 5 to around 6%. The Brazilian index, that's outperformed in the run-up to the election, contrary to what we have seen in the overall global market space. To give you a data point, the US markets, that's the Dow, is down close to 6%, but just in the month of October, the Brazilian index is up close to around 8% odd.
Okay, so important to track the Brazilian index today, but let's shift focus to the world of currency then. The dollar index eases after seeing highs above 96.8 last week, while the Japanese yen holds steady versus the US currency.
Well, turning our attention to the world of commodities then, Brent crude prices saw a bit of an up move. It's holding closer towards the $78 per barrel mark, supported by expectations that sanctions on Iran would tighten supplies.
Okay, it's time now for a quick break on the show. Up next, we'll get you all the cues and news you need to know for trade this Monday morning. Stay tuned.